Good morning. Welcome to Stock Market Today. It's Tuesday, October 29th, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email. Gives you daily stock ideas to consider in your inbox every trading day before the market opens. So diving right in, U.S. equities finish higher in Monday's trading with the S&P 500 marking a new all-time high on the close. Tech, comm services, and healthcare all rallied by more than 1%. Treasuries were weaker with the curve steepening. The dollar was weaker versus the euro, but better on the yen cross. Gold was down 60 basis points, and WTI crude after a big rally last week, gave back 1.5% yesterday. As we get to the desk this morning, futures are down about 10 basis points. Asian markets were mixed overnight. The Nikkei rose to a fresh 2019 high, though China fell by more than 1%. European equities are weaker. Treasuries are stronger across the curve. The dollar stronger against the yen, weaker on the euro. Gold little changed. And WTI crude is giving a little bit more back, down 80 basis points here to start the day. The chart of the S&P 500, we finally have our breakout to all-time highs. You can see us here punching through, closing at 30.39 yesterday. Now, key support does remain down around the 200-day moving average, call it close to 28.80. Below that, the August lows near 28.20. In the near term, to any near-term pullbacks, I think you want to start focusing on the 29.50 area. And that was the high back in April, and then a couple of gaps in between at around that mark. So 29.50, I think, is important should we pull back from these all-time highs. The RSI still holding in bullish ranges and actually moving higher, lending a bit of confirmation to the recent price strength that we're seeing. I would actually love to see the RSI push above 70 as a sign that there's solid momentum behind the trend. Chaikin money flow remains on a bearish rating, but is improving, actually right back to the zero line. So we'll see if we can punch through and get into a positive territory with today's trading. So all-time highs for the S&P 500, all-time highs for the Qs as well. Remember, we looked at the chart of the Qs yesterday. The only major market not getting into gear are the small caps, but they have shown some signs of improvement of late. Let's take a look at our market in a minute. What are we writing about today? Right. Well, we touched on the SPY and the Qs trading at all-time highs. Defensive sectors remain under relative pressure. Right. So think your bond proxies, also think consumer staples, as cyclical sectors continue to improve. It's part of that growth to value shift that we've been talking about. Tech breaks to new relative highs. We've seen that before. We'll take a look at the chart. Futures do point to a slightly lower open here today. As we look at the power bars for the major indices, still a bit of a mixed bag. The Dow up 44 basis points yesterday, but still 2-to-1 bears to bulls from a power bar perspective. The S&P 500, 58 basis points to the good, sees a slight improvement in this ratio, 111 to 92. NASDAQ was an outperformer, 23 bullish stocks, 15 bearish stocks. Small caps also an outperformer yesterday, 663 to 318. Bulls to bears there. Bonds down tick in price, sending yields higher once again. And technology was one of the standout groups on the day yesterday, helping the NASDAQ move higher. Tech adds 1.27% on the day, 13 bulls to 7 bears there. So according to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. The major markets are mixed. Our stock of the day, AK Steel. Now, we'll caveat this by saying it is a $2 stock, but the stock of the day is auto-generated based on the rating, which is very bullish for AK Steel due to very attractive financial metrics, very strong price volume activity, as well as strong earnings performance. The 20 factors that go into the model come out with that very bullish rating. We have a strong trend as the stock is above the rising long-term trend line, and the industry group is strong. So type of name we want to consider, and we're seeing a bit of a personality change play out here with the bullish rating or very bullish rating being met with a stock that's now outperforming the market. Now, we have seen this before. We've seen some fits and starts, but definitely a bottoming process playing out here for AK Steel. Stock is currently overbought within this kind of range-bound trade between $2 and $3, and Chaikin money flow is bearish, though it has been improving of late. So if you do look at these low-price stocks, I think AK Steel is one you want to have on your radar screen. Currently overbought, so hard to get really excited about it. But if relative strength continues to improve and we can work off these overbought conditions, for those of you who play these lower price stocks, I think AK Steel is an interesting name to have on your radar screen. Taking a look at the sector tracker now, movement of the major sectors over the last 5 days. Nice to see technology at the top of the list, over 20% of the S&P 500. So when tech is doing well, stands to reason that the market is likely going to do well also. So tech at the top of the list is encouraging. Just beware of the rotation that's playing out within the tech sector. Energy showing some signs of strength recently, although we'll see how it reacts now with oil pulling back for a second day in a row. Fundamentals on energy, still not a lot to get excited about. Although what I will say is that, as we highlighted in our note yesterday, commodities are starting to see a bit of improvement, and that's helping the materials sector. Industrials participating in that cyclical shift, as well as the growth to value shift. So those are your top four over the past 5 days. Middle of the road, healthcare, fins, comms, and staples. Discretionary, coming under some pressure. McDonald's really weighing on that group of late, as well as a couple of other names. Utilities and real estate, those are your defensive bond proxies, now beginning to roll over on a relative basis. We're going to take a look at that a little bit later in the show, but as rates have moved higher, the bond proxies have come under pressure. We'll take a look a little bit later. In industry in focus today, telecom services. Over the past 6 months, underperformed the market by over 10%. And the power bar ratio, which measures future potential, is weak, indicating that it's likely to continue to underperform. 11 bearish stocks for 5 bullish stocks there. Currently ranked number 19 of 21 subsectors. It has moved down 1 slot over the past week. So some of the names in that group that you want to avoid or potentially look for bearish opportunities if you do trade to that side of the book. Interdigital, IDCC, has a very bearish rating. Viasat, VSAT, has a very bearish rating, and Vonage, VG, has a very bearish Chaikin power gauge rating. And as we dive in on the group now, you can see why we want to continue to avoid it, right? Here's that power bar ratio, 11 bearish to 5 bulls, giving us or contributing to the bearish ETF power gauge rating. Now, the trend is being listed as strong here because it's above the long-term trend line, but this is a declining long-term trend line. We can clearly see the series of lower highs and lower lows, giving us the textbook definition of a downtrend, at least since the April timeframe. As we dig in on the sector a little bit further, or the group a little bit further, we can see the underperformance has been in place since March. Currently, the fund is overbought and rounding lower within an overbought condition, while Chaikin money flow is seeing an increase in bearish intensity. So this, just to me, is a group that you want to continue to avoid. Right, there are 5 bullish stocks in the group, but right, just going through, right, with the market breaking to all-time highs, we want to focus on the sectors and industry groups that are outperforming. You want to be focused on the areas of the market that are underperforming. And just to kind of give you a hint, over the past 3 months, the groups that are leading the charge, right, you want to be focused on names like the home builders. You want to be focused on transport, semis, banks, and regional banks, right? Those are all outperforming the S&P 500 over the past 3 months, and all have bullish or very bullish ETF ratings rather than the bearish rating that we see here for telecom. Taking a look at what's trending now. Yesterday's S&P 500 gainers and losers, our movers and shakers across the major index. Tiffany up nearly 32% as they have been approached by another luxury brand, LVMH, Louis Vuitton, Moet Hennessy, approaching Tiffany with some M&A activity, sending that stock higher by 32% on the day. Nectar, it's a volatile one. We've seen this one on both sides of the ledger here over the past few weeks. Nothing company specific to send the stock higher by 6% on the day. AMG earnings report sent that stock higher by 5.4%. Illumina, ILMN, sees a bit of a rebound. Stock was down 8% on Friday following their earnings announcement. Gets a little bit back yesterday, up 4.6%. Still has a bearish Chaikin power gauge rating. And Tyson Foods, TSN, seeing a little bit of a lift as there are reports that China may lift a ban on imported chicken from the U.S. That helped send Tyson higher by 4.6% on the day. PLD down on an announcement that they are buying Liberty Property Trust, LPT, sends that stock lower No real company-specific news on Molson Coors TAP. I will note that they are scheduled to report tomorrow. Stock down 4% yesterday. COG caught a downgrade to send that stock lower by 3.7%. DR Horton, the home builders, if we look at DR Horton, Lennar, Pulte, the home builders came under pressure yesterday. DR Horton, the worst of the group, down 3.5%, still with a very bullish rating in what is still a leading industry group. And PVH caught a downgrade yesterday to send that stock lower by 3.34%. Let's take a look at what we're talking about today, right? On Tuesdays, we look at our relative strength at the sector level. And I love the relative rotation graph because it gives us a quick view of how the sectors are rotating on a relative basis. And I have this kind of on a short-term basis in my note to clients. I look at longer-term trends as well, but the short-term rotations could lead to changes in the longer-term relative trends, so it makes a ton of sense to be paying attention to them. And what you'll see here are the four quadrants: leading, weakening, lagging, and improving. And in the leading quadrant, there's our financials, right? We've been talking about financials for a while. So on a short-term basis, definitely seeing an improvement in the financials as the banks have started to perk up. We talked a little bit yesterday about how insurance stocks were starting to weaken and the slack in financials is being picked up by the banks. Also leading on a short-term basis is healthcare, which should immediately jump out, though, or here are those defensive areas and your bond proxies, right? REITs, staples, and utilities all now moving into the weakening quadrant as the market breaks to all-time highs, and for the bond proxy, REITs, and utilities as rates move higher. And you can see the cyclical areas of the market improving. What are the cyclical areas of the market? Well, industrials, materials, and energy all improving on a short-term basis and being led by the financials. Tech is in a weakening position, but I will note it is starting to round higher. We're going to take a look at tech a little bit later on in the show here, but I love this chart, right? Shows you how the sectors have been performing, and you can actually see the rotation by looking at the tails. You can see the path that they've been taking, right? Financials have been improving for a few weeks now, right? For improving, and now into the leading position, right? Same thing goes for the industrials. Materials go from weakening to improving. Same with energy. So this is a great tool. The way it works is the sectors rotate around the center being the S&P 500. So what we're looking at is what are the sectors doing relative to the broader market, and the closer you are to the edges, the more extreme the outperformance or underperformance. So just something to keep an eye on. I love to look at the short term because it could inform the long term or point to potential changes in the long term. Speaking of those longer term trends, take a look at the bond proxies breaking down. The top chart is the utilities relative to the broader market. Now, utilities have been leading since May. Nice steady uptrend. Bumped its head on resistance back in early October and has started to roll over as rates have been rising. And you can see a breakdown now out of this consolidation. So here is the longer term trend coinciding with what we're seeing back here on a shorter term basis. That should lead you to kind of take notice as to what's going on. Same goes for the REITs, right? REITs have been outperforming for more than a year. Go into a consolidation, and now they're breaking down from that consolidation relative to the S&P 500. So as yields are moving higher, the bond proxies are coming under pressure, and now you can see it on both a trend perspective here and on a short-term rotation perspective back on the relative rotation graph. And we'll end it with tech, which is breaking out again. Now, we've seen a breakout before, only to pull back into the pattern. Tech breaking out above the rising 200-day moving average. RSI fails to become oversold on this most recent test, and the fund is also breaking out on an absolute basis. So when I look at leading areas of the market, obviously want to be paying attention to the financials, but don't ignore tech here, as it is once again breaking topside from a consolidation. That'll wrap it for today. I'll be back here tomorrow. Have a great Tuesday, everyone.